I'd like to thank you for coming to our presentation today, and a special thanks to Janice Henderson for hosting. We are Team 3. We are initiating coverage on Helen of Troy, a consumer goods company, with a recommendation to buy at $136 with an upside of 22% as of close on February 14th. Helen of Troy is a consumer goods company that acquires brands in the home and outdoor, health and wellness, and beauty industries. They have leadership brands such as Hydro Flask, like we may know, Vicks, and Drybar. Overall, this industry is currently valued at $18 trillion and is projected to grow to $30 trillion by 2028 with a CAGR of 7.5%. The characteristics of this industry are the low impact of new entrants, the moderate impact of buyer power, and the high impact of rivalry. Helen of Troy is a company that cares about the environment. They're currently working with the Ellen MacArthur Foundation to put how-to recycling labels on all of their packages. Their new distribution center in Tennessee will be LEED standard. Additionally, they care about having a diverse work environment with almost 40% of their director level and above being women, and almost 54% of the company being ethnically diverse. Their board of directors is almost split 50-50 men and women, with 4 women and 5 men. They also have a CEO approval rating of 96% as of 2022. They also have the faith and backing of large Black shareholders like Fidelity, JP Morgan, Allspring, and Vanguard, which sends a credible market signal.
Thank you, Amaya. Our buy recommendation and this credible market signal are driven by the same 3 fundamental factors: Helen of Troy's growth potential, its cost leadership and distribution, and its resiliency. Helen of Troy has acquired 16 companies since 2020, adding 9 total leadership brands to its portfolio. We think that this will help Helen of Troy drive market share expansion. We think that this growth will be supported by their strong gross profit margin, averaging 42% over the past 5 years. Impressively, this gross profit margin was increased by nearly 180 basis points over the course of the pandemic. Emerging markets are expected to grow 48% over the next 5 years. Helen of Troy's DEI-driven innovation and its proven ability to rapidly adjust to changing consumer preference means that it's in position to respond to this changing market climate and take over market share as disposable income increases in emerging economies. For example, their most recent acquisition, Curlsmith, has seen explosive growth in Asia over the past year. So we expect Helen of Troy to sell more products. We also expect them to sell them more cheaply with its efficient distribution network. Helen of Troy is a conglomerate, and that poses a huge risk of integrating acquisitions. And with their large volume of acquisitions, right now that risk is stronger than ever. Helen of Troy proactively takes steps to mitigate this risk by aggressively centralizing their business structure. We can see with their new Project Pegasus initiative, they're going from 3 main business segments to 2. And with their new North American RMO, we see a more centralized structure and sharing of services such as finance, legal, IT, operations. This all cuts cost, and we expect cost of goods sold and SG&A to save them $80 million over the next 3 years. So we expect Helen of Troy to sell more products, and we expect them to sell them more cheaply. We also know that their executive team has a proven track record of managing through tumultuous markets. We think that they're a very resilient company. So Helen of Troy's top 3 buyers are Walmart, Target, and Amazon. We ran a sensitivity analysis to see what happens to Walmart and Target's revenues as consumer income changes by 2%. We weighted this by their proportion of revenues to Helen of Troy. And we saw that because Walmart and Target have inverse income elasticities, this means that Helen of Troy is naturally hedged against changing market environments. If consumer income goes up, their purchase volumes are not expanded upon as much. And if it goes down, they're not decreased by as much because it's naturally hedged and offsets. So not only that, but we also see that Helen of Troy beats earning estimates 91.2% of the time. This is a testament to their executive team's ability to manage through tumultuous markets. So in short, consumer good companies need to differentiate. They need to create an economic moat through cost leadership and product differentiation. Helen of Troy has products that consumers love, and they have an efficient business model. Because of this, we expect them to see high growth, We expect them to see costs that are driven down, and we expect them to remain resilient with a strong leadership team keeping the helm steady throughout a tumultuous market. Thank you.
Thank you, Alden. Helen of Troy's expanding acquisitions and close consumer relationships and their industry-leading retail partners have shown a strong revenue growth. And with that, we forecast from 2023 through 2032 a compound annual growth rate of 3.01%. Helen of Troy's interest coverage ratio has an averaging rate 12x ratio as among its peers in our relative evaluation. And from there, Helen of Troy's Altman Z-score is a 3.006, showing that Helen of Troy is far from bankruptcy.
Thank you, Jennifer. So we can further support our buy recommendation based on a dynamic discounted cash flow model. We built this model to fit Helen of Troy's vast acquisition strategy and strong organic growth ability. Under conservative assumptions with a cost of capital of 8.4% and a cost of equity of 8.8%, we land at a target price of $135.89, representing a 22.61% upside. We further conducted a sensitivity analysis on our model's two main drivers. By varying the two, we can visualize their effect on our target price. We then found that our WACC calculation was highly influenced by our beta input. Thus, we weight our beta by market up days and market down days, resulting in an aggregate beta that accounts for bear market expectations in 2023. We further conducted a sensitivity analysis on our WACC's two main inputs. We can see that a decrease in the beta leads to an associated decrease in the WACC. This could mean that if bear markets occur, we would result with a target price far above our currently predicted target price. We then conducted a relative valuation on Helen of Troy's three main competitors: Yeti, Newell Brands, and Lifetime Brand Co. We found that Helen of Troy has a higher than usual EV to EBITDA multiple compared to peers, yet we believe this is due to their significant line of revolving credit. We also believe they can utilize this debt in times when demand for liquidity arises. We can further support our buy recommendation based off an EV to EBITDA target price of $129.95, representing an 18.6% upside.
Thank you, Ben. Helen of Troy faced risks associated with interest rates because their floating rate or their debt is linked to a floating rate called the Secured Overnight Financing Rate, and that debt is due in 2024. Additionally, the Federal Reserve has been hiking rates throughout 2022 and is expected to continue to hike rates throughout 2023. This could increase Helen of Troy's cost of debt. Helen of Troy hedges against interest rate volatility with interest rate swaps and interest income from cash holdings and short-term investments. We consider this risk to have a high probability of occurrence and low impact on our investment thesis. A second risk Helen of Troy faces pertains to its supply chain, as 88% of its finished goods are from Asia, and their suppliers can't store inventory. This means that if there's a halt in manufacturing operations, Helen of Troy would see a damage to consumer confidence and a loss of revenue. Helen of Troy mitigates this risk by leveraging its extensive sourcing expertise and cultivating productive partnerships with its manufacturers to quickly respond to supply chain disruptions. We consider this risk to have a low probability and moderate impact on our investment thesis. A third risk Helen of Troy faces is associated with a recession. Typically in recessions, consumer discretionary spending will drop, and this would result in a loss of revenue for Helen of Troy and a stock depreciation. Helen of Troy mitigates this risk by maintaining strong customer bases with Walmart and Amazon, who are positioned to deal with economic troubles that may accompany a recession. Additionally, their debts acts as a strategic advantage to increase their liquidity. We consider this risk to have a moderate probability of occurrence and a high impact on our investment thesis. Another risk Helen of Troy faces pertains to regulatory issues with the EPA and a lawsuit filed by Brita LP on December 23, 2021. We consider this risk to have a low probability of occurrence and low impact on our investment thesis. Thank you. This concludes our presentation, and we look forward to your questions.
Thank you very much. Let's go. I will restart the clock when your judges are ready to ask their first question.
At the beginning, you noted that the buyer power was weak. What about the distributors? They seem to be beholden to their major distributors, and they seem to have quite a bit of power.
Yeah, thank you for your question. So when you say distributors, are you talking about the raw materials, or are you talking about?
Talking about Walmart and Target and Amazon.
Yeah, absolutely. That's a great point. So Helen of Troy's retail partners, they have very strong relationships with them, and they work together to actively manage and optimize each other's inventory. So Helen of Troy's leadership is in direct contact with those companies' leadership. They look to sort of coordinate these supplies. So there's a high inventory turn for the retail side, and Helen of Troy knows how much to supply. So there is a lot of power there, but Helen of Troy's top 3 buyers, I think, make up about 45% of Helen of Troy's revenue, but they have a lot of other partners as well. And so while they're not beholden to a single particular retailer, and they've also been growing their direct-to-consumer sales channel. So now that makes up about 24% of their total net sales. And we expect that to continue to increase as consumer preference moves away from brick and mortar retail. Is there anything you guys would like to add?
No.
I'd love to pick on the consumer goods industry growing at 7.5%. If when people say consumer spending is 70% of GDP, GDP's not growing close to that amount. I mean, at least in normal times, maybe it is nominally now with high inflation, but how you get comfortable with that as a backdrop?
Yeah, absolutely. So when you talk about the consumer goods industry, are you talking about it globally or US specific?
Yeah, I'm just looking at your slide number 3, I think, strong long-term industry growth.
Yeah.
I assume that was US, but maybe that's the wrong assumption.
Yeah, absolutely. So that's the global market for US retail. And so we expect to see continue.
Sorry, you said global market for US, global market for consumer goods.
Yes, global market for consumer goods. Sorry, thank you.
Great. Thank you for the clarification.
I guess, how do you think about the overall industry growing at 7% number there? But I think your forecast for Helen of Troy, you have revenue growing 3%. Can you kind of juxtapose those two?
Yeah, absolutely. So we see that there's a small decrease in consumer spending that occurred with the impending recession. But we've already in January seen that consumer retail spending in the US is on the uptick. Wall Street Journal just did an article about it this morning. We think that there's going to be constant demand for Helen of Troy's products. People always want to look beautiful. They always want to have nice stuff in their house. And so long term, the industry is very bullish. And especially as emerging economies grow and real GDP per capita goes up, and people have more disposable income, we expect the demand for their products to accelerate. But Helen of Troy is already a big company. And so they get diminishing marginal returns as they get bigger and bigger and bigger. And so there's only so many people that Helen of Troy can sell a humidifier to, but we expect that to continue to grow.
Talk a little bit about the consolidation of those 2 business segments and how that perhaps ties into the increased revenue assumptions.
Yeah, absolutely. That's a great question. And so the Project Pegasus initiative is something that Helen of Troy started this year. This is meant to take their 3 main business segments. What were those again?
They're home and outdoor, health and wellness, and beauty.
Yeah, so they're supposed to take those 3 segments and consolidate them down into 2. And so that's build beauty and wellness as well as home and outdoor. So now they'll only have 2 major business segments. That combined with the increasing centralization of their North American RMO should allow them to share more services and get more efficient that way. Because beauty and wellness has a lot of synergies, a lot of customer overlap between both what are now independent segments. So coming together, it should make a lot of sense.
Right now, there is this movement towards self-care. I think it happened after the pandemic and we were all locked in our houses and we're like, let's do face masks. And so by streamlining the wellness and beauty sections, that's great for their business because I think now beauty and wellness are kind of aligning and coming together with more natural makeup looks and more focusing on healthy products and such. Yes.
Why you mentioned a couple of times you expect them to sell more goods more cheaply. Why do you expect them to cut prices? That's the implication I take from your statement.
Yeah, absolutely. That's a great question. So we actually don't expect prices to consumers to go down. We expect their cost of manufacturing to go down. Okay. They've already been able to raise prices with their retailers, and they haven't seen very many problems or resistance to that. And that happened mostly in 2022. And so a lot of their price increases to their retail partners are done with for the time being.
Got it. So expanding gross margins because their costs are going down, but they're keeping prices flat or raising them.
Exactly. So the volume of their product sales is going up and their cost of production goes down. So it expands margins from two directions.
Got it. Okay, thank you.
Where do you see the highest growth? Which of the business segments do you see the highest sales growth?
Mike, could you navigate to?
Yeah, I'm gonna have to go all the way back because we didn't have it linked, but
Okay.
sorry. You can play the Jeopardy music if you want. Okay, there we go. Okay. So it looks like home and outdoors is the majority of their.
Yeah, but going forward, where do you
going-
see the higher sales? Which of those segments is going to grow faster?
Totally. I think that beauty, I know it's lowest on this scale, but I do see that there's this huge movement with the beauty industry, especially because of like TikTok and influencers. Influencers right now like drive the whole beauty industry, and the products that they recommend are the products that people buy. I am totally one of those people who are influenced by influencers. And so I think looking at the beauty industry in general is super interesting, especially, yes, because of this new movement of influencers. And I think if Helen of Troy's marketing team is on it, and like especially their brands like Drybar and Revlon are super popular right now, I think that personally this is where they're going to see the most growth.
And just to add on top of that really briefly, their most recent acquisition, Curlsmith, that company has seen a really high growth, especially in Asia and emerging economies like that. We expect that growth to continue as emerging economies expand.
What's your geographical client base look like? So if you go back to slide 11, where you had that breakdown of the EM, is that, I mean, how does it tie into their revenues?
Yeah, that's a really good question. And revenue grows across their different, so most of their revenue right now occurs in North America. Most of their sales are made in North America. I think it's somewhere around 79%. I think that was in 2022. So geographically, they're very concentrated in North America for the time being. But we've seen that growth in Asia. We expect to see more growth in emerging economies because of their company's character. It's very diverse, and their customer base, we expect also to be diverse with their recent acquisitions. And so we expect that this puts Helen of Troy in line with what consumers value. And that's their strategic advantage because it allows them to sort of understand consumer preference better than companies who are a little bit less diverse.
So as you think about the growth opportunities, how do you expect Helen of Troy's M&A strategy to feed into those different opportunity sets?
Yeah, absolutely. Rylan, do you want to speak to Helen of Troy's sort of interest rate risk? Because kind of like what your question reminds me of is they've taken out a lot of debt to buy these companies, and they've bought in a lot of companies. So that poses a huge risk. What if they don't pay off? Well, you've seen them already divest. They've divested around 50 million from Latin America as part of their Project Pegasus initiative. And they're on the ball in terms of reallocating capital. And part of their strategy is to pick out winners, products that have wide margins and high volumes of sales, and focus on those specific brands. And even within those brands, those specific products. Their interest rate does pose a slight threat, especially in an inflationary environment when interest rate risk goes up. Do you want to speak to that?
Yeah, so currently the secured overnight financing rate sits at 4.55%. This is relatively high, but Helen of Troy has enough cash flow and they can really combat this interest. So they have no chance of going into default and they are in position to deal with it.
Yeah, and Jennifer, what was their Altman Z-score and interest coverage ratio again?
And the Altman Z-score is at a 3.006, and then their current Altman Z-score is at a 20x ratio.
They had a very robust share repurchase program going for a while when their stock was quite high, and now they've kind of cut it out. What would you say to that? What's your opinion?
That's a great question. So Helen of Troy doesn't pay dividends. So they have to return equity to shareholders through stock buybacks. When times are good and their margins are expanding, I think that's a great opportunity to return that capital and equity to shareholders. But right now, we see that they're reinvesting that capital in making sure that their operations are as efficient as possible, and that they're poised to come out of a recession on top. Ben, do you want to speak to how they use that capital and how we factor that into the DCF?
Yeah, absolutely. So they're able to return that capital investing like new things, like their new distribution.
Thank you.
Thank you.
Thank you.